Hey guys, Matt here. So first of all, if you're returning to my channel, I want to apologize for the title of this video. I'm about to talk about some what I call boring stocks that, aren't very exciting, maybe won't get a lot of views on YouTube, and so I have to draw people to the video somehow. But in this video, I want to go over 3 consumer stocks. Now, Walmart is not one of the stocks, I promise. 3 consumer stocks that I think might be worth looking into. Now, in researching this, I had a lot of trouble, and that's because consumer staples, as of right now, I think has had a huge run-up over the past year because of the pandemic. Like, for example, we got Walmart here. Let's see if I got this. There. Because during the pandemic, when everything was shut down, and Walmart was one of the essential businesses, and the stock is shot up 32.77% since then. And their PE is really high. Target is even crazier. Like, Target has shot up since the pandemic. We'll do right from its lowest point. We'll say it shot up 176%. Like, that is insane. Now, this is probably well deserved, but I can't buy this stock at this price. I can't do that at all. The first stock is Walgreens. This is a stock I already own. This is a stock I bought, I think, back in June or July, somewhere around then. I was looking at this stock at the same time as CVS. Now, I'm not going to cover CVS in this video, but CVS is a stock I also am pretty interested in. However, I mean, Walgreens presented an opportunity that I just couldn't pass up. It has a forward dividend yield of 4.06% as of right now, so it's pretty high. Which is fantastic. Now, the opportunity came here. I like stocks that have gotten the crap beaten out of it. That's what I go for. I try not to go for stocks that are just already shooting up to the moon and all that stuff, because that's FOMO, and I want to stay away from that. Walgreens had earnings roughly around June the 30th or so, something like that, and despite very strong earnings, the stock has dropped like 10% since then. And I bought it somewhere around here. I don't remember exactly where, but it was an opportunity I just couldn't pass up. And if we take a look at the 5-year chart, Walgreens is definitely not one of those consumer staple stocks that have shot up during the pandemic. Like, from a 5-year chart, it's down. And that was mainly due to, for starters, due to its role in the whole Theranos thing. But, this is the pandemic. I'm pretty sure Walgreens wasn't shut down because of it, but since the pandemic, the stock has dropped off overall at 20%. So again, it's probably terrible. It's probably not the best news if you already own Walgreens and have owned it since then, but for someone who's just looking to get in, I felt it was a great price. Now, the good thing about consumer staple stocks that I found is that their business model is really easy to explain. So Walgreens, it has they have stores all over the country, and I think they have, through acquisitions, some presence in Europe and Asia. But Walgreens, it has a retail component, it has a store where you can buy products like, retail stuff like cosmetics, groceries, critical supplies, stuff like that. And it also has a retail pharmacy section. That's what it does. Looking at the valuations, it's got an amazing 4 PE. The PG ratio is NA because I think analysts expect the business to shrink this year. I don't know if that's going to happen. That's just what analysts expect. I mean, we can't take analysts' word as gospel. It's fun to look at, but I think there's some growth out of it this year and over the next 5 years. But right now, the 4 PE is amazing. Price to sales is amazing. Price to book and enterprise value over revenue is not that bad either. Now, normally I go down here to talk about the dividends, but the thing with Yahoo Finance is that Yahoo Finance uses net income as far as a payout ratio, which I don't think tells the whole story. We're going to go to Seeking Alpha. Seeking Alpha uses free cash flow as their dividend payout. Here you can see that the dividend yield, 4.06%, and annual payout of $1.91 per share. Payout ratio is just under 40, which is fantastic. The 5-year growth rate. Now, I'm buying Walgreens as I bought Walgreens not as a growth stock. Obviously, I don't think it's on a 5 or 10x. I bought this as a value stock and as a dividend stock. And as a dividend stock, it's doing very well. Dividend growth, 6 consecutive years. Can't be mad at that. As far as revenue, I think it has pretty decent growth for a not growth stock. If we take a look at the net income, yeah, now this was as of 2020. This was their lowest moment during the pandemic, so I'm not too mad about that. And it has been bouncing back, which is the point. They had a really strong earnings last quarter. Now for the revenue by the quarter, now I'm going to their 10Q because formatting in Yahoo Finance made it difficult for me to show on video. But they went from 30.3 billion to 34 billion, and they swung from a massive loss as of last year because yeah, things were pretty bad last year to a very substantial net gain. That's fantastic. Absolutely fantastic. Balance sheet is looking really good. Now, I did it by the quarter since that's the best reflection of their current, balance sheet. The balance sheet is looking really good. Now, let's talk about this total debt for a second. Now, you might be looking at this, and I did at first, thinking, what the hell is going on here? Well, I'm not sure where Yahoo is getting this information because if you look at their latest 10Q, this is their latest 10Q, the short-term debt and long-term debt put together total about just over 15.5 billion. Now it's a lot, but that's much less than the 40 that they're reporting. It's less than their total equity, so that if they really wanted to, they could pay all that off. Operating cash flow has risen from 17 to 2018, but has been dropping since. The free cash flow is, dropped quite massively since 2018, but seems to be starting to climb back up. If we go to the quarter versus quarter last year, we see it start to come back. So Walgreens seems to be a, like I said, it's a turnaround play for me. Analysts are predicting negative revenue growth this year, but we'll see how that turns out. But a jump in EPS and a jump in EPS again for the year following that. So again, I mean, we'll have to follow Walgreens to see how it turns out, but I think Walgreens is going to be a major contender, which is why I already bought in. I think the market is just really confused. Well, the market's been confused since last year, but again, I think Walgreens is a fantastic company and it may be worth you looking into. The second stock is Tyson. Now, this is a stock that I am very, very close to buying. The reason I haven't bought it yet is because my portfolio, one, I'm not completely done looking through this stock yet. There's still more research I have to do. But the main reason is that my portfolio has 20 companies in it, and I really don't want to add too many more companies. I think 20 companies is a lot. However, this is looking like a snack. Now, you can see there was a major drop-off since January, which I still have to look through. But since then, this is a stock that has, benefited a lot since the pandemic. About 35% overall. However, if you take a look at its valuations, you will see that its 4 PE and its trailing PE are holding very steady. This is very nice. PG ratio, it actually has one. Very nice. I prefer it to be under 1, but this is not a growth stock, so that's fine. Price to sales, price to book, revenue, these are looking very, very nice. If we want to take a look at its dividend payout, now, its dividend payout is not exactly the highest of all time at a 2.5%. However, its 5-year growth rate is 26%. 26%. Payout ratio is under 30, and it's been raising its dividend consecutively for 9 years. So the business model of Tyson is also very, very easy to explain. It sells meat. Well, it sells protein. Chicken, beef, pork, and prepared goods. That's what it does. I'm sure there's more to it than that, but that's what it does in a nutshell. Their revenue has been pretty amazing as far as growth over the years, especially even in 2020, which, companies that don't perform the best of all time in 2020, I don't hold it against them at all, given what happened. But revenue, pretty great. Net income, pretty great. If you want to go to their balance sheet by the quarter is looking real good. Assets to liabilities. Debt's looking not too bad. It's got way more equity than debt, which is fantastic. Their cash flow is looking really good, really strong. Let's take a look at their analyst estimates. Again, not gospel, but it's fun to look at. We're looking at 4.3% growth, 3% growth in the year after that. Pretty big jump in EPS. Now, So I was so impressed with Tyson that I went ahead and did a DCF on it just to get a ballpark cash flow. Now the thing with DCF is the results you get vary wildly based on your assumptions. So what I did is I stole this amount from Yahoo Finance, and then I took the mean and I assumed 3.9% revenue growth, and then I took the mean from this and the mean from that, and I did assumptions based on this. I had a fair value of $92.88. Now, what I like to do, because I know DCFs are based on assumptions, is based on how good I feel, I would either take 90% or 80% of the fair value. And if you scroll down here, 80% is $74.30. So even with 80%, I still think Tyson is worth it at this price. And I think Tyson is looking like a snack right now. Again, I still have a lot more research to do on this company, but as a value stock, as a dividend stock, maybe with a little bit of growth, not a 5x or a 10x, but this is looking, like I said, like a snack. The third stock on my list today is Kroger, and I'm including this because I think Kroger would make for a pretty strong dividend stock right now. I don't know if it's the best value stock in the universe, but it's a stock that's on my watch list. Kroger, it sells groceries. That's its entire business model, and it's a store that I love going to. If you're in the U.S., you probably live near a Kroger. It's headquartered in Cincinnati, Ohio, which gains points for me. My thumbnails of my videos, if you look at my background, they're all cityscapes of Cincinnati, which is where I'm from. Kroger is a stock that has been, it's deemed essential, but it has run up quite a bit since the pandemic. So I didn't know if it's the best value stock of all time. Right now, the dividend yield is 2.01%. We'll get to that in a second. The metrics, it has a 4 PE of 14.12, which is below the 15 that I require. PG ratio is a bit high. Price to sales is looking pretty good. Price to book is decent. Enterprise value to revenue, The main thing that I look for with these type of stocks is 4 PE and price to sales. And PG ratio is a nice to have. Now, the dividend yield is not the highest in the world, but its payout ratio is only 27.39, so it has room to grow. The 5-year growth rate is 11.38%, and it's been raising its dividends for 15 years. That means this right here, as far as I'm concerned, this is a stock that, if you're a dividend investor, you basically put a flat amount of money into a stock each month or each week or however you want to do it. And you don't even look at the price. And the idea is that over a long period of time, as long as Kroger keeps raising these dividends as it's doing right now, you could make a lot of money in dividend payout. Revenue over the years has been looking pretty good as far as the rise in prices, especially here. Like their rise in revenue, this is probably attributed to the pandemic. Kroger is essential. A lot of money flocked to this place. Net income looking pretty good as well. Kroger's balance sheet is looking pretty decent. Now, again, the total debt looks very scary, but if you look at their latest 10Q, you can see, let me see if I can make this a little bigger, ladies. The long-term debt, $12.9 billion. Now, that's still not it's still above their equity, but it's way below their assets. So, I don't know how grocery stores are expected to work as far as the assets liability, how the trend is going. Well, I think the balance sheet is fine, especially if you're just buying Kroger for dividends. Analysts aren't really pegging this for the highest amount of growth in the universe. They're with 0.10% growth. Now, they've beat every quarter. So I want you to keep that in mind, that they're probably going to beat all these estimates. But I'm just saying, if you care about analysts' opinions, they're not really poking this for the greatest growth in the universe. And as far as EPS, they're pegging this as a drop in next year and the year after. Probably as the pandemic hopefully subsides and we get back to normal and all the growth that they had because of the pandemic, starts to even out. But again, if you're buying Kroger for a dividend stock, which is why I'm putting this on this video, I don't think this matters. I did a DCF for Kroger. Right now, I'm not really looking for another dividend stock, and I think the price is a little high right now. Yeah, assuming I want a 10% return, I would need the price to drop in assuming I'm 90% sure, I would need the price to drop below $30 before I'm interested in buying in. However, if you're looking for a dividend stock, a purely dividend stock, I think Kroger might be worth considering for you. But anyways, take care, have a great day, and eat your vegetables.